SMCI hitting record highs.
Maybe we should change the name to Supermicro. Because the stock is not micro anymore.
Supermicro Computer, you're looking at shares surging ahead of the open, up nearly 10%.
Up a whopping 36%.
Huge rally, up more than 600% over the past 12 months.
Supermicro is clearly the big winner.
The company forecasting stronger than expected sales.
Some of the biggest customers of this company are Nvidia, Intel, and AMD.
Something crazy is happening at Supermicro Computer, and SMCI stock has more than tripled in the last month alone. And whenever I see that kind of growth, there's really only one question left to ask. Is this the top for Supermicro stock, or are their best days still to come? Your time is valuable, so let's get right into it. First things first, I'm not here to waste your time. Here's everything I'm going to talk about up front. What Supermicro Computer does exactly, what I see as their two biggest competitive advantages, I'll cover their latest earnings call and what caused their stock to triple, and of course, whether I think SMCI stock is still a good investment as a result. I should also mention that I only buy stocks when they drop below my price targets. Research tells me what to buy, but price targets tell me when. So if you want to see those, I'll leave a survey link in the description. It only takes about 20 seconds, and your responses help me provide the most value. Alright, let's dive into Supermicro Computer. Although they might seem like an overnight success, SMCI is not a new company. Supermicro was founded in Silicon Valley in 1993, the same year as Nvidia. In fact, SMCI and Nvidia's San Jose headquarters are only about 6 miles apart. That's not a coincidence, and I'll explain why in a little bit. Supermicro was founded by a Taiwanese electrical engineer named Charles Liang, who is still the company's CEO today, and its second biggest shareholder right behind BlackRock. SMCI started out making motherboards and computing subsystems that other companies would buy to build their own servers. Charles Liang realized pretty early on that Supermicro shouldn't just build components, they should build the whole system. And by the late 1990s, SMCI was focused on designing, integrating, optimizing, testing, shipping, and even installing pre-configured end-to-end data center solutions for their customers. Today, Supermicro offers everything from full-scale server and storage systems down to individual workstations and networking devices for a wide variety of markets, like cloud services and enterprise data centers, to AI training and deep learning, and even 5G and edge computing. And almost all of their products are ready to go out of the box. Companies just plug in the power cables and the data cables, and they're up and running. That's a fine business model, but here's where things get really interesting. Instead of competing with companies like Nvidia, AMD, and Intel, Charles Liang decided to partner with them. So SMCI isn't really the next Nvidia like everyone is saying. They're more like the next Taiwan Semiconductor, but for a different part of the data center supply chain. While TSMC makes and packages advanced chips for other companies, SMCI integrates those chips into tailor-made data center solutions, adding the right power electronics, cooling, and high-speed networking solutions, and even the right firmware and software depending on the application. And here's a quick spoiler for you. SMCI's server and storage systems account for 94% of their revenue, with subsystems and accessories making up the other 6%. And Supermicro's revenues are up by a whopping 73% quarter over quarter and 103% year over year, which is right up there with the kind of growth that Nvidia reported in their most recent quarter. I've been buying Nvidia stock since it was well below $200 per share, and $400 and $600. But Nvidia is not the only company growing fast in this massive AI boom. Lambda Labs provides other companies with infrastructure for deep learning. Everything from clusters of Nvidia's H200 GPUs and Grace Hopper superchips to on-demand cloud computing services for AI training. And they work with some of the biggest enterprises in the world, like Microsoft, Google, Amazon, and even the Department of Defense. But Lambda Labs is still a private company, so we can't just buy their shares on the stock market. That's where Link2 comes in. Link2 is a platform that makes investing in pre-IPO companies easy and affordable. They always show you what the company does, its market opportunities, and of course, how valuations are changing over time. For example, Lambda Labs' valuation went up by 9x last year alone. And right now, the minimum investment through Link2 is just over $2,500. No wonder they already have over 600,000 investors on their platform. And right now, Link2 is giving my audience $500 off your first private investment when you use my code TSYOU500. But this offer ends soon, so start building your private equity portfolio by using my link in the description below today. Alright, in my opinion, Supermicro solutions have two big competitive advantages. The first is that they're headquartered in Silicon Valley. Like I said earlier, that's not a coincidence. While most original design manufacturers like Foxconn are based in Taiwan or China, Charles Liang had the foresight to realize that the best way to meet the computing needs of other Silicon Valley companies is to work right next to them. That way, by the time one of their partners comes out with a new chip, Supermicro's solutions for that chip are almost ready as well. For example, as Nvidia designs a new data center chip, like say the Grace Hopper Super chip, those designs can be shared with Supermicro, so that they can start designing and optimizing the boards, the connectors, the cooling, and the other components needed to keep the super chip at peak performance in an actual server rack. And since they're right down the street, updates and changes are easy to manage as well. But Google headquarters is only 15 miles away from Supermicro, so they can work together with them to make sure that Nvidia's chips, or AMD's, or Intel's, are optimized for the right workloads and the right data centers that they'll actually end up in as fast as possible. In fact, Charles Liang set up every single part of Supermicro to focus on this one metric of success: how fast can SMCI's customers get the best computing solutions up and running? That's because lowering the time to market means their customers can start earning returns on their infrastructure investments faster, especially if they're getting the best chips up and running before their competitors. And this is where Supermicro's other big competitive advantage comes in. From day one, their server solutions have been completely modular. Supermicro calls their modules server building blocks. Some servers are air-cooled, while others require water cooling. Some customers might need more memory, while others want more storage. And of course, some data centers want more CPUs, while others are buying up as many GPUs as they can. Supermicro also has server building blocks for basic power, cooling, interconnects, and networking that can each be optimized for different markets or for specific workloads. This building block architecture is what lets SMCI move so fast in so many different verticals. When a company like Nvidia launches a new chip, Supermicro doesn't need to design a whole new server system for it. They just need to design a new building block that already connects to the rest of their ecosystem. And of course, as this ecosystem keeps growing, it makes more sense for more data centers to support it. SMCI has building blocks for Nvidia's Hopper GPUs, AMD's EPYC chips, Intel's Sapphire Rapids, and many more. That means Supermicro can design, build, test, optimize, and deliver server solutions to customers in weeks instead of months, and for much cheaper than their competitors, which again means a quicker time to market. Charles Liang's ultimate metric for success. While these are clearly big competitive advantages today, they come with some big key man risks. Although Supermicro is headquartered in Silicon Valley, their primary manufacturer is a company called Abelcom Technology. Abelcom is located in Taiwan, and its CEO is Steve Liang, Charles Liang's brother. In fact, Supermicro is very dependent on Charles Liang overall, not just because of his experience designing the server building block architecture or leading the company, but also because of these family ties to their primary manufacturer and the deep partnerships that he's built with chip companies, cloud service providers, semiconductor suppliers, and other customers over the last 30 years. That's a lot of personal networking to eventually take over from Charles, who's already in his late 60s. And while there's no doubt that he's built an absolute monster of a hardware company, that's not enough to decide if SMCI is a good investment, especially at these prices. To do that, let's take a look at their earnings next. A couple of weeks ago, Supermicro Computer reported earnings for their Q2 of 2024, since their fiscal year starts in June. They had record revenues of $3.66 billion for the quarter, which is up a massive 73% quarter over quarter and 103% year over year. That's because they're seeing record demand for AI systems specifically, including modules for Nvidia's A100 and H100 GPUs, Intel's Gaudi 2 accelerators, and AMD's MI200 and MI250 systems. And I expect that demand to continue with their next generation of modules for Nvidia's upcoming H200 and B100 Blackwell chips, their Grace Hopper Super chips, as well as the next generation of AMD's Instinct and Intel's Gaudi platforms. There are a few things in SMCI's latest earnings report that really stick out to me as an investor. First, they're hyper-focused on expansion. Just like Nvidia, Supermicro's biggest problem right now is keeping up with demand. They were shipping about 300 racks per month in 2021, but in 2022, they almost 10x their capacity to ship over 2,000 racks per month. Now, that number doubled again, and Supermicro has ongoing expansions in California as well as Taiwan for manufacturing, so I expect their production capacity to keep growing fast. Besides capacity, they're also expanding the types of solutions they provide. Like I said earlier, SMCI started out by making different subsystems and components for servers before making the switch to selling complete systems themselves. Today, those systems make up around half of their revenue, but they're also seeing a lot of revenue growth for their total IT solutions, which include optimized software, firmware, and ongoing services. The second thing they're focused on is capturing market share, because the markets they operate in are all growing fast. Right now, they break their revenue into 3 different verticals: 5G and edge computing, large data centers, and enterprise data centers, which is where all the cloud computing and generative AI training happen today. The global cloud computing market is expected to almost 4x in size over the next decade, which is a compound annual growth rate of around 17%. The global edge computing market is expected to grow even faster, about 4.5x over the next decade, which is a compound annual growth rate of over 18%. And of course, the global artificial intelligence market is the hottest market on the planet. It's expected to more than 15x in size over the next 10 years, which is a staggering 37% growth rate. So SMCI is going to benefit big time from providing the computing infrastructure for all of these markets, even if they just keep their market share the same, let alone if they keep expanding faster than their competition. That's why their gross margins are declining. They're aggressively pricing their products to get into as many data centers as possible. This is a very smart move for the long term, because remember, Supermicro has that unique building block ecosystem with all kinds of different plug-and-play modules. That makes their solutions very sticky, not just because it's faster and cheaper to get them up and running, but they're also easier to upgrade and maintain over time. If data centers want to keep those advantages as companies like Nvidia, AMD, and Intel come out with new chips, they'll need to stay with Supermicro to make it happen. But even though their gross margins are declining, their operating margins are staying steady and even increasing a bit since their revenues are growing so much faster than their costs. So to me, Supermicro's growth actually looks very healthy overall. They're not just burning money to acquire new customers at any cost. They're expanding their production capacity, their number of products, and the markets that they operate in aggressively but intelligently, because they know they have a unique data center solution that drives down time to market and the total cost of ownership for their customers. No wonder they crushed their revenue guidance of $2.8 billion for the quarter by over 30%. They're guiding for $3.9 billion next quarter, which would be around a 205% increase year over year. Like I've been saying in every video, the key to finding great stocks is understanding a company's products, not just their profits. Massive growth happens when a company has the perfect product for a new or quickly growing market. That's exactly what we're seeing with SMCI, and that's exactly why the stock has basically tripled year to date, even after a 20% drawdown at the time of this recording. Alright, I talked about what Supermicro Computer does, their big competitive advantages, their earnings, and why their stock took off like a rocket. Now with all that context, let's talk about whether I would buy SMCI stock at these prices. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That really helps me out, and it lets me know to put out more deep dives like this. Thanks, and with that out of the way, let's talk about the right price for SMCI stock. Supermicro is a great way to gain exposure to the data center hardware market during this AI boom. Every time Nvidia, AMD, or Intel come out with a new chip, Supermicro designs and manufactures a new set of modules to add to their growing ecosystem of server building blocks. So they're benefiting a bit from the hardware network effect, economies of scale, and of course all the tailwinds associated in operating in some of the fastest growing markets on the planet. Kind of like Taiwan Semiconductor, but in a different part of the data center supply chain. On top of that, their revenues are growing much faster than their costs, and their forward price to earnings ratio is only around 36. Given how fast their earnings are growing, I'd expect this ratio to keep shrinking over time, even if the stock price continues to skyrocket. So for all those reasons, I don't think it's too late to buy SMCI stock. I would average in over time, especially if we see more days where the stock drops by 20% or more. I've been holding Nvidia stock since 2016, and I know I'd seriously regret it if I stopped building my position after the stock had tripled. I think the same will be true for Supermicro Computer over the long term, and this is why it's so important to understand the science behind the stocks. Thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.